Hello, and welcome to the 2Q26 edition of The Credit Corner. I'm your host, David Klink, Director of Credit Research at Meter Public Funds. Today, I want to walk through what we're currently seeing in the investment grade market and where we think investors should be paying the most attention heading fast into the middle of 2026. I'll start with several observable signals we're picking up from investment grade, or IG, credit markets. Credit spreads, the extra yield investors earn over U.S. Treasuries for taking on corporate credit risk, still remain low, though often not as low as 3 months ago when they were at some of their lowest levels ever. These spreads have vacillated a bit on U.S. Iran concerns, though their still low level indicates investors continue to believe we're in a strong mid cycle economy. Even high yield spreads, where we would expect to see more fluctuation than IG spreads, have remained fairly stable. Note an interesting dynamic here. Credit spreads take as their anchor the level of AAA credit spreads, and then add on additional compensation to take on AA credit risk or single A credit risk, and so on. In recent weeks, while we have sometimes seen a modest increase in single A credit spreads, the vast majority of that has come from that anchor level of AAA spreads increasing, rather than much repricing of the risk of holding AA or single A credits. So the translation of all this is that we view any increase in spreads as merely reflecting changing investor views on the riskiness of corporate credit in general, rather than differences between these ratings classes as might be expected in an actual credit downturn. My comments so far have been on an aggregate basis, but within IG, we are starting to see some welcome dispersion based primarily on sector, and to an extent by how far out on the credit curve the investor is willing to go, which we view as a healthier dynamic than when corporate credit was priced tight everywhere in monolithic fashion. Finally, we assess investor demand for fixed income as a whole, as proxied by the flow of investor funds that we're seeing into the space. We have seen very strong flows year to date, though it's debatable the exact extent to which this has been driven by the AI hyperscalers like Amazon and Oracle, or globally active banks heavily front-loading issuance related to their CapEx plans or funding needs. What does seem pretty clear from the data is that we're seeing the beginnings of another year where IG fixed income is well received, under the continued theme of spreads are tight, but yields are all right. On fundamentals, the story also continues to remain constructive. Corporate debt levels are generally in line with recent historical averages. Bank capital ratios are robust, and leverage levels are low. Credit metrics like non-performing loan levels remain solid. In fact, for many single A rated companies, we're seeing net debt drift slightly lower, driven by ongoing strong profitability. We also continue to run stress tests on our approved issuers, and the results are reassuring. It would take a fairly severe downside scenario to cause even modest pressure on credit ratings. In most reasonable stress cases, the impact would show up in lower profitability, not balance sheet deterioration. That said, there are still important open questions. One is what the future path of policy rates globally looks like. Markets have recently moved to pricing in, at best, a flattish future path of rates, and in the case of net energy importers like the UK, pricing in several coming hikes. This is in contrast to just a few weeks ago, when it was widely expected that benign inflation and varying levels of political pressure would result in more cuts over the next year. Recall that one of our bigger concerns entering the year was that credit repayment statistics have likely been artificially boosted over the last year as rates have kept coming down, making it easier to repay floating rate loans like credit card debt. And now it's reasonable to wonder what happens to the more strapped of these consumers if rates start rising. This consumer is already managing the impact of tariffs, and we continue to point out that just because 2025 didn't bring any tariff pain doesn't mean that wasn't just postponed. To paraphrase the author of The Black Swan from the financial crisis era, no evidence of disease does not mean evidence of no disease. Another question we have is whether the steady drumbeat of negative headlines about private credit will prove to be more than the latest block on the market's wall of worry. The current focus is on limits on redemptions being enforced across several private credit funds. While that seems like a reasonable liquidity driven decision, it's possible that where there's smoke, there's fire, and some of the underlying loan portfolios really are problematic, particularly those heavily exposed to software lending in this age of AI upheaval. The markets seem to currently be saying, hey, if there are any problems, it's going to be concentrated in maybe a few funds, and that's that. But they said the same thing about two Bear Stearns hedge funds in 2007, before it became apparent that they were a counterparty to someone even bigger, et cetera, et cetera. Finally, we continue to take a wait and see approach to the heavy amounts of M&A transactions or AI capex that we're seeing, wondering if these will really pay off or become bridges to nowhere. I hope you have found our most recent edition of the Credit Corner informative. Thank you.